Narnolia is very well known for research, and today we have amongst us fund manager Mr. Shailendra Kumar, who will explain us, what differentiates Narnolia and what is the secret behind performing so well. The 3T PMS of Narnolia is one of the best wealth creator products in the last 5 years. And over to you, Mr. Shailendra Kumar. We would like to hear from you, the entire in-depth philosophy behind the research.
So, any portfolio, whether a PMS portfolio or a mutual fund portfolio, ultimately is a selection of few securities, right? Even India 3T fund, the Narnolia PMS fund, has a very similar, some security like selected and bought. The difference lies in the kind of stock you buy and the kind of allocation you do on each of the securities. So this is the key differences where every fund will be different. When it comes to our way of selecting a stock, what differentiates us is like the extensiveness of our research that we do on a stock, or what we call a kind of a 360-degree framework that we look when we buy a stock. And we use a kind of a deductive reasoning framework on every stock in our portfolio that we own. We do this detailed analysis, and every stock has to pass through our deductive reasoning framework. I'll just explain this thing. The reason why you need to own a framework is basically there's a thesis. Something or a company that cannot be bought for 10 years should not be you should not buy that even for 10 minutes. So that's the basic paradigm. And to figure it out, that if a company is good to own for 5-10 year framework, you have to do a very detailed analysis. Right. Just simple where the EPS is growing, just simple where ROE is going, will not give you an understanding whether the company would be creating wealth in 5-10 years or not. Because that simple financial matrix will not work you. If your purpose is to figure it out, the investment worthiness of the company in that long a framework, you require more in-depth understanding. Now, what are the various things that you have to figure it out for a longer horizon investment? See, every business ultimately is solving a problem.
Right.
So, society wants something, and a business goes and provides it. So, any product or any services that a business is providing, ultimately solving a need, solving a problem of the people in general. So, for every company, when you are working out, understanding the business, understanding the problem that is this company is addressing for the its customers is very important. So, understanding the business is very paramount. Secondly, every businesses are functioning in a particular environment, which we can call it macro environment or economic environment. Now, these environments are never constant. The environment keeps changing. So every businesses has to continuously respond to the changes happening in the environment. So you have to understand the business environment and the delta in the environment, how it is happening. And you have to have an in-depth understanding of what product it sells, what is the target customer of it, how the preferences of the target customer is changing over time. So that's one part of it. The second part is understanding the leadership and the management. Ultimately, every business which is being run right now was a vision of somebody, some CMD or a promoter or a founder or something like that, or maybe a board's collective decision. So what are those vision? What is the leadership direction in which they are trying to move? And these can be seen in terms of the product attribute. When I say product attribute, I mean where they are positioning the product. Because a particular kind of appetite in the market can be addressed in a number of ways. Say, for example, people want to buy a two-wheeler. Now, in two-wheeler, there are many alternatives. You have a scooter, you have a motorcycle. Again, in the motorcycle, you have 100cc, 150cc. So, what the strategy is in terms of where to position my product or my services, if I am in a service business, right? Not only in terms of product, what is the pricing strategy they are playing out for? So every different segment of the market or the business, there are different pricing strategies that the management has to devise for itself. Along with product and the price, you have to understand how the supply chain of the business is working, from the manufacturing to the end customer, how things are moving, whether a product or whether services. So as I said, you have to understand the business environment, the changes in the business environment. Then what are the strategy of the leadership? What is the strategy regarding the product, positioning, the branding, the pricing, and the supply chain of the how the product starts from manufacturing and goes to a customer ultimately. Apart from this, you have to understand the kind of managers the company has. They might have a great plan, but they might not be having a very nice execution capability. So the other aspect is to figure out whether whatever the leadership vision is. I've met many company. When I meet the leadership team, they'll give you a X particular vision for the next 2 years, but you figure out they don't have the management depth to actually execute it. So this two aspect of understanding the business and understanding the management, understanding everything around the business and understanding everything about management, that gives you basically an edge where you can figure out. I'll give you an example. So apart from product price, you can look at how the finances are the finance is getting handled by the management. So every company in their balance sheet gets money from many resources, through equity, through bank borrowings, other bond issuances, so debt kind of a money. And third, very larger part of the financing in the balance sheet is a retained earning. So every year company makes X amount of profit, they make some dividend, and the rest of the money is going in the balance sheet finance. So they are raising money ideally through these three different means: equity, debt, and the retained earning. If you look at the last history of the management, how much money that they got in the balance sheet and how they deployed those money. So with that money, they can do a operating capex where the operational business they can enlarge. Large part of that money might have gone into working capital, addressing the working capital issue. Some part of the money might have gone into financial investment. Some part might have gone into subsidiaries or say related party transactions. So how the whole piece of the money is moving inside the company, that will give you an idea how the management is handling the money part. So one is how they are handling the market part, which is product price and other things. Other part is how they are handling the finance as well as the HR issues, how the company structure is there. So once you look at all these business and management issue, you figure out whether the company is worth to own for 10 years or not, right? See, these are non-financial understanding of a business. Look at it this way. Once you say the margin has gone up, so I am buying a company. Now you have to know that margin has gone up because something has changed in the PLBS cash flow. The annual report has changed, right? But why the annual report has changed? Because of all those issues that I talked about, the business, the environment change, the management strategy and the execution. In the end of 31st March, when an annual report is published, the annual report is the end resultant of whatever action has gone in the company. Right. It's not that the annual report, after the annual report, action happens, right? Annual report is ultimately a statement which tells you what they did a year back, 10 months back, 9 months back, and what the impact on the financials are. So this piece of the market is very important, where you understand the business and the management. Once a company passes our understanding through these two metrics, then that company is something we look in terms of possible a candidate to buy in a portfolio. From possible to actually buying, there the stages are the investment style that we have, which we call growth in value. So we buy only those company where the return ratio is improving in a foreseeably 2-3 year kind of a time period. So a company to get into our radar has to have this attribute of a 10-year kind of investment story that somebody can buy and hang on. Then actually buying decision depends upon whether I look into the company and see the company growth in value characteristic is getting exhibited or not. Now when I say growth in value, the word value I'm not using from valuation. I'm using the word value from valuability. So if the company valuability is improving, when do you say company is more valuable? So between two companies, if the one company is enjoying more margin, you will say, okay, this company is more valuable, right? Or out of the two companies, one company is having higher asset turnover ratio. So like the capital employed is say only 10 lakh rupee and the turnover is say 1 CR. So 10 time asset turnover ratio. So we look at these parameters which ultimately positively impacts the return ratio, which is ROE, ROC and free cash flow. So once we have determined a company can be owned for 10 years, then we figured out in the next 2 to 3 years whether this company will have higher return ratio in the foreseeable 2-3 year earning. The moment we identify this fulfills, that stock becomes our buying candidate. So that's the extensive kind of a work we do on stock selection. And naturally we have a huge amount of strategy regarding what kind of money has to be allocated upon it. And I think a lot of our edge that we have in the market is that side of it. Like And third, we do not ignore the macro cycle. We know for sure the macro cycle plays. So ultimately, if you've done a good amount of bottom-up research, you will do fairly well. But to add to your bottom-up research, you have to have an understanding of macro cycle, because macro cycle will give power to what your bottom-up research is telling about ROE improvement or not improvement, right? So we use that also in our research. So it's like three stages, I can call it. First, basically, whether this company is investable or not. So in a 10-year time frame. Then whether it is good to own for next 2-3 years or not. And then thirdly, using the power of macro understanding to figure it out that how much confidence you will have on your bottom-up research that you have done. And then the allocation regime.
One thing which I have seen in Narnolia 3T PMS is that you guys are different in the context that you take cash calls, right? It's not that on day one you will deploy the entire corpus, right? Unlike some of the other funds who deploy in one go. So also I have seen that you do some tweaking with allocations. So how would you explain this particular aspect? What gives you, so I think maybe you, because you're doing so much research, you're managing each portfolio in a very customized way, right? So would you like to explain this particular aspect?
Okay, let me take the cash thing first before we go to allocation. What are basically edges there when we meet our customer, and PMS is a very customized portfolio for each of the customers. So we don't have a very generic one go, one fit for every of customer. Largely the scheme remains same.
Right.
But our first job is clearly identifying the risk and the return possible for every asset classes, and letting the customer know very clearly how things are. Now, once that customer gets aware and takes a conscious risk reward decision, then for each of the asset classes, maybe equity for example. So if in the equity, once he's aware about the risk return characteristic possible, then we advise them or we ask them, you want to put all your money in the equity right now, which depends upon a function of what your own risk appetite in the market is. The other way is advising somebody to stagger the money in 3 months to 1 year time frame. So it's a very customized. For some customers, like all deployed one go, depending upon what the customer own risk return characteristic understanding is like. So I can tell you about a very asset class where I'm thinking gold is moving, where I'm thinking rupee is moving, where I'm thinking large cap is moving, where I'm thinking pharma is moving. But once you are aware about the various asset class possible, whether the physical assets or the financial asset, and in the financial asset all kind of a financial asset, then it becomes very easy for a customer to take a very prudent allocation call. And inside the allocation, if a timing is required by customer, we surely always welcome and handle it in a staggered manner. Some client go for 3 months kind of a stagger, some even go for 1 year kind of a, and we always welcome that decision. Because see, my role is more to get my customer know my perspective on various asset classes, right? It's not like 0 equity and 100 cash or 100 equity 0 cash. Now those are the situations you face very rarely in your investing lifetime. Say, I'll give you an example. You want to go cash when you feel your principal will not come back, say in 5 years also. Because market is non-linear. Market will never give you a fixed percentage return every month, quarter or a year. It's a very lumpy kind of a payoff from equity investment. So I know 1 year something can happen, 2 years something can happen, but I will have a limit to how many years of adverse situation I want to, still I'm okay with my portfolio, right? Say you decide that, or you decide the market peak. So somebody say, why don't you sell at peak and go cash? My understanding is you have to define first the peak. What is the peak? Every day, intraday, there is a peak in the market. Is that the peak for you? So you will have a perspective. For me, a peak is the one from where the market for 5 years will not make a new peak. So if that is the horizon you have in your mind, that today, we had a close to 12,100, 200 kind of a peak for Nifty. Now, if your belief is that 2019 the peak was 12,200 and even 2023 this peak will not be broken, then surely you should take a 100% cash call instead of being in equity, right? So that's the perspective. Now, that kind of situation can occur when? If you look at the multiple cycle in the world, a price peak or a market peak happens not because of only valuation peak. Valuation was very high. It happens when the fundamentals were too good. So every market peak, you remember 2000, 2007, or global Japanese market or any other market. So 1989 when the Japanese market made a peak, that time the fundamentals were great there. The earning growth was 30%, more than 30%. Or say in our case, in 2007, think about the kind of a so EBITDA margin of Nifty or Sensex was closer to 20%. The ROE was higher than 20%. The earning growth were more than 25%, and we made a peak, right? Market peak happens, a fundamental market peak happens when the fundamentals are too good, right? If there is a too good a fundamental and too high a valuation, then you can be in a situation where for 5 years you might not make any money. But in a scenario like the way where we are, or where we were say 3 months back also, the fundamentals were not great. We are all talking about earning degrowth continuously. So if earning is degrowing, margins are at close to say last 5-6 years low. ROE of the broader market is close to say 12%, which is a lower of the basic the band. In that scenario, when the fundamentals are not good, only valuation is high. That price peak is something which will get broken once the earning revives, because the combination of high valuation and high fundamental gets to a point where the peak is not broken for very long years. So that cash and equity call has to be taken sometime. So like it's not you have to buy and just be with the stock for 20-30 years. You will have in your lifetime couple of occasions where taking a cash call will be very, very prudent, right? Of course we are not there in that market for, at least for Indian investor right now. I don't see any reason why for every year we will not make a new high. I don't see any reason for this. Our fundamentals are too average or bad, I would say. That only thing which can happen in 3-5 year time frame, which is usually the time frame of our investment. The fundamentals, both in terms of sales growth or a PAT growth or a margin, will be better than where we are today. So if the fundamentals improve in 3 or 5 year kind of time frame, you cannot think of a market where cash call is important. But in terms of risk return on various asset classes, you have to take a conscious allocation call, I would say, not a cash call in that sense.
So what are the positives that you see, at present? Fundamentals, as you're saying, in terms of earning numbers, sales numbers, profit numbers, they're not good, they're bad, and it is reflected in the broader market
Correct.
indices. But what are the positive factors that you see, which make you feel confident when you're saying parallelly that, there is no reason that Indian equity market should not make new highs?
Right. Okay. So see, there are two things. How the next cycle will start. That's the I think key thing for in our mind, right?
Yeah.
There are two things. What has brought us here? If those forces weaken, you build a base for the next rally. So that's the first thing, is what has brought us, say like maybe say 1.5 year of bear market in India, not in Nifty but in broader market. The forces that played a role in that, once those forces start weakening out, you can start thinking in terms of some base building in the market. And then you need a trigger which will take you to the new trajectory. So this is ideal how the cycle turns, right? Look at where we are today. I think close to 75% listed company in India are down by more than 25% on say 1 year time frame. Many of the funds, PMSs and other, also are down in some kind of a bigger number. Fortunately for our PMS, we have been able to resist this fall to a large extent. Now, what has brought us here? Look at it this way. And are those forces which brought the market to a level like this, are those forces weakening or not? We all agree the credit cycle is what is giving a pain in the market right now.
Yeah.
Now let's divide credit cycle into a couple of sub parts. One, your NPA cycle in the banks, because banks are either do not have ability to lend or do not have willingness to lend.
Yeah.
Primarily because of NPA cycle. Then you have liquidity constraints, so liquidity cycle, and then the credit itself. Look at NPA cycle. So between 2014 and 19, or I think 18 end, total NPA for Indian banks were 18.6 or something like crore. So almost 18.5 lakh crore of NPA asset got built in India. What was the total loan book of India in the beginning of 2014? Only 65 lakh crore. So out of 66 lakh crore lend in the market, close to 18.5 lakh crore became NPA. Now, today the total advances of the banks is 100 lakh crore. And add all the news that we are listening about this company going default and that company going default, at the number is hardly 2 to 3 lakh crore. So on a lending base of only 67 or 66 lakh crore, 18.5 lakh crore went NPA. Still our banks have survived. Many of those, particularly the private sector name. Now at 100 lakh crore of base of lending, 3-4 lakh crore will not be a difficult if you look at the near past only, right? So NPA for sure has peaked some quarter back. The problem is the large NPA, that 18.5 lakh crore of NPA, was from few corporates. So the noise was less. Now this 2 lakh, 3 lakh crore of NPA, possible NPA, is from many number of corporates. So the noise are more. The value is less, but the numbers are more, so there is more noise. But practically for a bank, what matters is not number of NPA account, but extent of an NPA account, right? So NPA cycle is now over. To my mind, we have seen the worst of NPA. From here on, of course, in the last 2-3 quarter itself, if you look at the number, the NPA slippages has reduced substantially. And I think from here on, it will be continuously reducing. That's one part of it. Look at liquidity cycle. So 2018, July, August, when the ILFS crisis happened, the whole money market became almost a fridge. So no bond was issuing, no one was interested into a bond, and we got into a kind of a liquidity cycle. So remember, every analyst in 18, almost the whole of second half of 18 was calling about RBI should do more of OMO, open market operation, and RBI did a humongous amount of OMO between October 2018 and March of 2019. For last 4 months, there is no OMO. Since June, the liquidity is surplus in the system. So your NPA cycle is over, your liquidity cycle is over. So the problem which brought the market to a level where so many stock has fallen so much, the reason behind those problem with the cycle has receded a lot. Credit cycle still remains broken. Why? Because those who can afford to, those whom banks are willing to lend, they are not willing to borrow. And that segment of the market or the economy which are interested into more borrowing, banks are not willing to lend. So it's kind of a lock between a willing, non-willing banker and non-willing lender. So that's a kind of a lock. Now whether this lock will remain for a very long time, no. We have already passed the NPA cycle. We have already passed the liquidity cycle. This is the last piece of the puzzle which has to get solved, right? So 2/3 of the problem is already over. Okay. So maybe the market also, the whole fall 2/3 is over, or maybe more than 2/3 is over. We are towards the fag end of the problem. Now this problem, fag end means, doesn't mean tomorrow is going to go end. It might take another 2-3 quarters, or maybe another 3-4, or maybe more than 2 quarters. But look at it this way. Next budget is just, how many months? 5 months away.
Yeah.
And the kind of feedback loop which is going back to the government from industry in terms of what is happening there is going very rapidly. We all aware about this. So there is a good amount of chance that government intervention will make, so naturally if this cycle, the bad cycle has to end in 1 year, because of the positive intervention, the cycle might end in only in 3 to 4 months. So why I'm talking about, I'm not believer in terms of government intervention. Market always, it's like, always takes its own balance and it starts a new cycle. What government intervention does is shorten the pain period, right? So I hope something can happen. So maybe 2 quarters you can think about a pain, or maybe 3 quarters at the max. But where we are, the forces which were trying to make things problematic for India has receded almost. So 1/3 pain is there. In terms of newer cycle, look at it this way. Every bank is in the business of lending, right? Right now they are lending only to AAA borrower and getting a 9% kind of yield, 8.5-9%. Whereas AA minus can give you 10.5% yield. But even the banker is not willing there. Once for few quarters they make good amount of cushion of the profit, naturally 3 quarters down the line, the same credit manager will be willing to lend to AA minus, and the cycle from AA minus to AA, and then will simply move on. So the credit cycle by default, as a natural cycle, it starts moving in. We are towards the end of the problem of the credit cycle, and things will start. Whether the government intervention will make sure that the journey starts early or it will take couple of months, is that the only question mark, I think. And then from there on, we'll have another structural bull market.
So, in economics we say that market is an invisible hand which ultimately creates equilibrium on its own. Mm-hmm. So you're basically hinting to that.
Right,
so you're saying if that equilibrium has to happen, then maybe 2 quarters down the line, eventually automatically it should happen.
Correct.
Because it's already receding. if government intervention happens, then
Could be
you know,
faster.
it could be faster.
Perfect.
Brilliant. So given this as a context, right? So what is it that now at this juncture, in terms of sectors, in terms of industries, you're looking at in your portfolio? So basically tell us about your portfolio construct at the moment, and what is it that you are going to add, so that we are able to kind of make a view that
Right.
what can be seen in the portfolio holdings in terms of sector allocation over say next 1 year.
Right. See, if you look at our portfolio right now, it'll appear to be a very large cap biased portfolio. Back in 2017 January, I think 2/3 of our portfolio, Narnolia India 30, I think 2/3 was mid and small cap. Right now, 2/3 is large cap. And this transition, 2017 beginning, almost first quarter calendar year, first quarter 2017, we kept on reducing our mid and small cap exposure and went on increasing large cap, which went on till middle of 2018. And since last 1 year, our cap wise weightages are very similar. I'm pretty sure down the line 1 year, this will again reverse. It will go back to where it was in 2017. Now let me give you. I'm not taking a conscious mid cap, small cap bet. We try to be as neutral as possible on the cap side, but I know the growth in value principle, which I said, automatically starts throwing you more ideas from those segments where in the foreseeable 2-3 year time period, the return ratio is going to improve. Let's look back first, why we reduced 2017 first quarter itself. We started reducing in first quarter itself. See, 2013, the Indian bond yield was above 9%. Now 2017 June, July, we came to almost below 6%. And there was a point from where bond yield had only one way to go, which was up. Now, for the mid and small cap segment of the market, the cost of equity will start becoming higher if the interest rate goes up. The cost of running the business, so cost of capital you can call it. And difference between the return on equity and the cost of return on business and the cost of business will reduce. So so then once you see which all company will be having a characteristic of growth in value, you will find lesser and lesser number of names when it comes to mid and small cap. And that was the reason why we kept on reducing the rate. It was not cap decision, because our basic investment philosophy itself started throwing us more ideas from the large cap name, because the other ideas, the mid and small cap, because of the rising interest rate from from below 6% in 2017 middle, the interest rate went above 8% just in a 1 year time frame. So like below 6 in 2017 June, it went 2018 July almost 8% plus. Now, our model was able to factor, because understanding of the macro cycle that we feed into our bottom up research. From here on, what will happen? Look at from 8.5%, our bond yield has fallen to 6.5% now. So the key reason why you had a shift from one segment of the market to another segment has to play in a reverse manner. Also, because of GST implementation, the valuation multiple of mid and small cap expanded humongously, because GST will lead to formalization in the medium to long term, and a large cap company doesn't face any competition from an unorganized segment. A Reliance doesn't have any competition from a small shop, right? These small and mid cap company, particularly small cap company, are basically on that line where the organized and unorganized segment stage. So once you keep or build a thesis, the organized segment will become larger. Naturally, the first beneficiary will be those who are on the border of the two lines, which were the small cap. Now, this hope since 2016 led to a very high valuation level. So, very high valuation level, and then cost of capital rising was a cocktail where people missed out on how to change the portfolio composition from one side to other side. That's it. From now on, what will happen? For sure, the cost of capital is now reducing, and it will keep reducing, because inflation trajectory is very clear where it is. The crude is very clear where it is. The chances of cost of capital reducing or staying where it has come now 6.5% is much higher. a B borrower or BB plus borrower still is paying huge amount of interest rate. So for them the rate has not fallen. For 10-year bond yield, the government sovereign bond yield fell from 8% plus to current 6.5 or something. For a B category borrower or the lower BB plus or BB minus and below borrower, for them the interest rate is still 12.5-13%, right? Once the credit cycle improves, this spread between a safe 10-year bond yield and a small cap company, BB minus rated company, the yield difference, this spread will reduce. Once the spread will reduce, actually this advantage of cost of capital, reducing cost of capital will start flowing to a smaller cap company, and that will be the point where the small cap company will start improving. Valuation is already cooled up, so that's not a big hangover anymore right now. Only thing, this transition where the spread between a BB minus kind of a player, a corporate and a sovereign, that has to reduce. It has not reduced. Still, the term structure is right now quite high, but I think couple of quarter again they will start reducing, and that will be our trigger when our bottom up research will start throwing those ideas which are more what is called small cap and mid cap. So it's not a conscious decision of buying more mid cap or more large cap or now buying more small cap. But once you have this micro cycle understanding, then your bottom up research starts throwing you more of a growth in value idea, where ROE will expand, where free cash flow will expand from that segment of the market where macro headwind will start favoring.
Right. And you certainly believe that given the recent experience of various lenders lending to triple B rated companies or low rated companies, the rate of interest for them in 2 quarters or 3 quarters will it certainly come down in spite of this recent experience?
Will start coming down. Will not come down drastically. See, the credit cycle doesn't go off in one day. So this pain in the credit cycle, overall pain will remain for quite some time. It will not go anything in a hurry. See, lot of borrowers on a smaller borrower, they give their real estate as a mortgage to borrow usually. Now, the bigger concern in the real estate cycle is such where your mortgage value of that real estate lien is little bit, no one is trying to bet, no one is trying to take a risk on rightly valuing a real estate project right now. So that why I'm saying this, that means the problem will not get over in 2 quarters. It will take longer time period, maybe another 6 quarters. But once the delta starts improving, once incrementally things start moving, the market is not something which will move in the end. Right. Market will always move much before the actual pain is over, right? Market will see the delta, whether the pain is reducing or pain is increasing. The day market reads the pain is decreasing now, pain is there, but it's decreasing, it will start front-ending that move in the actual economy. So economy will take time. Economic healing is not, see the kind of a structural reform this government has done. So the way 10 years back the way Indian businesses were happening, and I'm pretty sure that 10 years hence from now, how the businesses will happen in India will be dramatically different. जुगाड़ है, चलता है, approach will simply gradually will recede, and more rule-based business processes will be happening. Now this some practices which were there for hundreds of years, and you are changing it now on a rule-based economy, rule-based business processes. Sure, there will be a pain. Sure, there will be a period which will from where the pain will be there and pain will grow gradually. But is that transformation is bad in a structural sense? No one will say this is bad in a structural sense in the longer run. Surely there is a pain. It will take time to get over. But market will start rising before actually the pain is over. That's the key message. So you have to be attentive where the delta is receding, where the pain point is receding. The moment it will start receding, the market will start having. So you have to be very carefully looking at this. Don't get into the negativity loop. As I said, NPA cycle also, the number of people defaulting are much higher now. So there are a lot of news, but the amount of default is much lower than what it was in say 2015-16, right? And for a bank, what matters is amount of money going default, not number of people going default, right? So the noise will be here. Don't get trapped into it. Look at the opportunity. Look at the point from where the things start moving incrementally better. So I'm not saying let the thing become better. Know the point where the incremental things start moving better, and that's the point where market cycle will front end.
So given the fundamental rule book changing, which is visible and which is what this government is kind of elected for by a majority of
Right, right.
Indian population. So do you think a research approach, because Narnolia is research, basically research backed organization.
Right.
So methods of research, like you said, the financial reports are common to everyone. It is the interpretation of one from the other which differentiates, which makes one as a buyer and other as a seller, maybe, right?
Right.
So, when you say that over next 10-year period, the companies which are today may not be there, and the flavor industry sector will be different, right?
Correct.
So, in that context, obviously, research methodology interpretation, will also change. So, is Narnolia doing, a change in their research methodology in these regards and making it equipped enough to be able to manage this shift and migration?
Right. See, living through many multiple cycles. So, like our investment team is there for last. We have seen through at least 5 peak and 5 trough in our career, and our system and philosophy has evolved over those this thing. So, first time when you face that kind of a change in the market, you usually are off guarded. But for us, seeing so many various peaks and trough, we were always equipped. Even now, and we are equipped for future as well. I'll give you a couple of things. As I said, initially this notion of for this company the profit will come a lot higher, so buy it, or this company profit has come a lot higher, so buy it, is something where you're seeing one side of the coin and you will be trapped. So along with this you have to read the annual report. But as I said in one of your question, even the annual report is a outcome of what decision has been taken by the management and what delta has happened in the macro changes. So what happens if from there till the final financial ratio, so financial ratio, books of account, which is PL, BS, cash flow, all the schedule of asset, liability and others, contingent liability, etc. To initially what the changes in the marketplace is happening, what changes in the management strategy is happening in terms of product, price, financing, supply chain. If you can just join the whole together, which our deductive reasoning framework does, then you know for sure this company is good for 10 years. Now whether something being good for 10 years should be bought in your portfolio for 3 years, you look for the near term financials, and that you do that in a rigorous bottom up research basis, whether the margin will go up, whether the asset turnover will go up, the forces or the delta change which is happening, is that change sustainable for another 3 years, or the kind of margin expansion I'm seeing. So like a company margin expands for a quarter and you buy because it's a good company, margin expanded. But if you don't figure out for how long this margin expansion will happen, is very critical. Secondly, as part of our philosophy also, we buy for a linear changes. Sometimes what happens, because of some news, this company has a lot of land bank, so it will go a value unlocking, right? And you buy that stock because you see some SOTP valuation and you become comfortable. We don't buy those stocks because those are non-linear payoff. If that land piece is not sold for 3 years, for 12 quarters, your thesis doesn't have any PL outstanding, right? You don't have any profit loss account understanding of how things are moving, right? We buy only company where the operating region why we are buying. So maybe we are buying something for higher margin. Then that margin has to be incrementally rising in a structural manner for over next 3 years. So we don't go for a lumpy, jump. Suddenly something will become better in FY21, so buy it. No, we want to buy something today where we see from here to 22. Incrementally for every quarter there will be some positivity. So this linearity is very important. Otherwise you can go a lot off guard because you might be thinking it's a great company, I have bought a great company, I should stay with it forever. No, that's the clear lesson. Then your portfolio delta beta will be very high. So in a fall like the one we faced, so let me add on there. Investment strategies is important. But if your investment strategy doesn't have an inbuilt risk management strategy, then just investment strategy will not work. Look at it this way. There are a lot of literature to find out the next multi-bagger stock. But you don't have in academia or any places a lot of literature on how to avoid a multi-loser stock, right? So you keep thinking about how to identify a multi-bagger stock. You do not focus on how to avoid the multi-loser stock. At Narnolia Research, if we have done say like work on how to identify a good stock, we have done more work on how to avoid a bad stocks. So we have done more work because it's not available in literature. So more of your empirical learning of your life and your research work has to focus on how to avoid a loser stock, right? And it's very important in a risk. And what happened in 2018-19, you saw the power of that coin. Why we were like doing good in 2012, 18, 17 period also. Even 17, 19 we have survived pretty well in the market. Because if you don't have this risk management framework where you know how to avoid, how to identify the trade in a stock, that this company will be a multi-cycle loser, right? So, or it will be a structural loser, or maybe cyclical loser, but cyclical loser by a big margin, and how to avoid those kind of situations. So that's very important. In terms of allocation also, you have to be very smart. How much of money to put on a single stock? If you don't have a specifically defined rule for yourself, say for example in India 3T, our benchmark is S&P 500, and what we do is we don't take more than 5% active risk. Now, when I use the word active risk, we don't buy a company more than the weightage in the benchmark by 5% plus minus. So if a stock has say like 3% in the benchmark, I'll not buy more than 8%. Right. So that's the kind of a not only in terms of a specific stock, even for sector. Say like pharma is, or maybe banking is say 35%. Now if you buy big percentage lower than the banking, then you are taking a very active risk on banking stock, right? Or if you buy too much of a bank, or say energy is 10% and you buy 25% energy, your bottom up research might have thrown you ideas, based upon that only you bought, but unconsciously you have taken a sector bet. And we ensure that neither we do a single stock bet, nor do we do a sector bet, nor do we do a theme bet. Every portfolio or a benchmark will have a theme bet. So in India you have a BFSI, credit market related kind of large segment. You have consumption segment. You have a lot of investment cycle segments, so industrial and players like that, and you have a lot of global cyclical. So metal could be in global. You fall IT, pharma. So you have 4 or 5 major theme which plays out in India. If you take a very lopsided exposure to one of the theme, you carry a different kind of a risk. Now, sometimes some risk you might take, but you call it that you have consciously taken a risk. And you have to be aware that once you take that kind of a risk, your portfolio is prone to higher kind of a volatility, and you have to be very, very clear about that, right?
Perfect. Right. Thank you so much. It has been a pleasure talking to you.
Thanks, Kamal.